When we would raise capital for a deal, what I realized early on was there were two things new investors had to get comfortable with. They had to get comfortable with the deal, and they had to get comfortable with me. And as we started going into these new markets, one way we fostered relationships with new family offices was bringing in local groups. I realized that we were a brand new firm that had a couple transactions under our belt. But if I had a really good value proposition or a really good business plan or arbitrage on a deal in their backyard, it was hard for them to not get comfortable with the deal. And all I had to do was then do what I said what I was going to do, being honest and thoughtful, and they would get comfortable with us.
So the entrepreneurial journey is something that is really inspiring to me. And I'm curious to know about the early part of your career and how that led into you becoming an entrepreneur and starting your own company and what you learned during your process of working for other people.
Sure. Yeah, great question. I think I've always kind of had an entrepreneurial spirit since I was like a young kid, whether it was selling lemonade on the corner. I used to sell lemonade on the corner. I'd bring my kid brother and dog out to sit in front of the lemonade stand just so people would ooh and ah and think it was cute, and I could sell them $5 cups of lemonade. Or selling sodas on the beach, or I sold this Ravens Revenge thing at summer camp. I sold a spring break passes in college. I promoted clubs. I always kind of had an entrepreneurial itch. When I started my career in the corporate finance world, I started at Morgan Stanley, working on the CMBS desk, doing origination, securitization, and I loved kind of corporate finance and understanding the quantitative side of financial products. But what I very early on got excited about with real estate was the tangibility of the asset class, the ability to roll your sleeves up, get your hands dirty, and really effectuate change and understand the product that you were investing in and control the product that you were investing in a physical domain that really doesn't exist in a lot of other asset classes. So early on, great experience at Morgan Stanley, working on their CMBS origination securitization desk in the large loan business. Moved over to Jefferies and did investment banking there, and then had a really exciting opportunity early in my career to help start Triangle Capital, which was effectively functioning as a real estate investment vehicle for a family office, and had a tremendous experience there, helping grow a team from 3 folks and a Bloomberg, effectively in a broom closet, to a really institutional player. We did about $1 billion of acquisitions on the CUSIP side, about $1 billion of acquisitions on the loan side, or loan or REO side. Learned how to buy real estate of all asset classes and all geographies across the country. Learned how to build a team, and had the opportunity to do that effectively for somebody else as one of their lead players, building a unit there. And then decided it made sense to try and create that on my own. And here we are.
What are some of the biggest things you learned on someone else's dime while working under that umbrella that you've taken with you with your own capital?
I think first off, how to price and understand risk, how to protect the downside, and how to really understand that downside. Creating an asymmetric risk profile, minimizing your downside risk, and maximizing your opportunity for an outsized upside return. I think, whether it was my experience out of the GFC buying distressed notes and REO assets, whether it was my experience on the debt side originally, I was always kind of downside focused as a debt investor at heart. But what else did I learn? I think early on I learned that I could really understand a lot of diverse markets around the country. And whether it was growing up in LA or having spent a ton of time in New York, understanding these very complex real estate markets, I found it less challenging than expected to wrap my head around, particularly second-tier markets, and had the opportunity with Triangle to invest in 50 some odd markets around the U.S. and really garner an understanding of the who, what, where, when, why fundamentals of those markets and how people live, work, and play and shop and interact with the physical domain in those markets and what drives supply and demand. And it just gave me a level of comfort to come into a new market and underwrite it in an effective manner. I think a lot of people in this business fear being non-local, um, and think that the local operator has an edge. But if you really understand the core principles of supply and demand and why people want to use space in a certain manner in that respective market, you can understand your own value proposition, uh, your own pricing, and you can put yourself in a pretty favorable spot. So we like to say at SomeraRoad, know thy markets. And I think I learned uh, how to learn and know those markets at an early phase of my career.
Do you think that more local focused real estate GPs or operators tend to miss some of the big macro signs that maybe give you a competitive advantage when you think about risk and how to price the risk and what the upside could be?
Absolutely. I think there's two sides to that coin. On one hand, um, local operators have a deep rooted understanding of the market from a block to block, building to building perspective. They can hometown you in terms of their relationships with tenants, particularly in the office market. They're there constantly and they see it. On the flip side of that, as a more national operator that's got a bigger geographic footprint, we can have relationships with tenant from a market to market basis. We can see trends before they move to another market. We can have kind of a macro view of how things are behaving in a particular space, and we can apply one to the other. On the former, I think what our firm has taken a lot of pride in doing is we say act like a local. Don't let we don't let a local operator have an edge on us, and we do that really three ways. First and foremost, understanding on our way in, uh, deeply understanding the market fundamentals and market behavior. Two, we read local news at SomeraRoad like you wouldn't believe. Uh, I personally follow Kansas City, Pittsburgh, Indy, and Nashville news as if I live in those markets every single day. And folks on our team are responsible for covering local happenings across all of our markets. So we have it's not just a day one understanding of a market, it's a progressive understanding of what's happening in the market as if you were a local. Um, and then lastly, we've opened 7 offices around the country outside of our HQ in Nashville and New York. We have offices in Pittsburgh, Kansas City, Austin, Indianapolis, and Tampa, and that's largely to have boots on the ground, really understanding the constant changing dynamics in those respective markets, um, and having those like organic collisions that happen in the real estate world when you're not working. Does that make sense? Like you only really understand a market when you're like out with your kids on a Saturday grabbing brunch and like the those are fundamentals that you learn uh, that you can't learn like on a Tuesday work trip. Going back to you asked another question, Jake, earlier with regards to um, what I learned, in my prior experiences. I'd also say the challenge of building or helping build a firm, coming out of the GFC, and taking nothing and building into something really substantial, uh, really proved to me that was possible. And it gave me like I'd say I had a lot less fear of what was possible in the space, what I was capable of, and what could be built if you put your mind to it. You know, we have a lot of sayings at SomeraRoad, but one we take a lot of pride in is nothing is hard. Um, listen, there are certainly things in this world that are really challenging, like brain surgery. I'm not going to pretend to figure that out tomorrow. But in our space in real estate, particularly because it is a physical domain, it's tangible. Um, we can figure out any asset class. You just have to ask the right people, the right questions, be willing to learn, know what you don't know, and constantly challenge yourself and kind of build that encyclopedia in your mind. And we can figure out how to understand businesses that are tangential, whether it's industrial one day or retail the other, or over the last couple of years taking a deep dive into hospitality. there are nuances that we have to pick up on and get up to speed on. But if you challenge yourself, I think getting there isn't as hard as a lot of people think. If I could unpack one other thing there, sorry.
No, do it.
If I could unpack one other thing there, development is the perfect example of something that we kind of just challenged ourselves and said, hey, nothing is hard. We can figure this out. We had a handful of development sites, 4 specifically, 1 in Pittsburgh, 2 in Nashville. We had a handful of development sites in Nashville, Pittsburgh, and DC, and we spent a lot of time exploring JV relationships and whether we should partner with a group to co-GP and develop something together. Why? Well, I'd heard my whole career a lot of value add or investment firms or debt shops say we don't develop, right? I'm sure you've heard that's a classic line. People always say development's just one thing we don't do. And I think a lot of people just take that at face value and accept it. We never really take things at face value. We always kind of dig in and ask the question. And we start kind of trying to unpack that. Why not develop? What is that incremental risk? What is that incremental understanding or skill set that needs to be had? And we spend a lot of time with these JV partners on the development side, and you sit across the table from them, and you're like, can we just figure out how to do what you do? Not ourselves, but can we augment our team and bring in a master of that craft, a subject matter expert to sit alongside us and execute that strategy ourselves? And that's just what we did. I mean, on the development side, 4 years ago, we said, hey, we should probably internalize this and figure this out. We met with 40, 50 people, different candidates, to try and find the right fit. Came down to a few, and in the end, things really clicked with Andrew. And Andrew Donchez is my partner, oversees our development business. Fast forward 4 years later, he's built a massive development practice here. He's got 15 people on his team. We have 4 projects out of the ground across the country, and a $2.5 billion pipeline of new projects to come as soon as the Fed fixes our little interest rate situation. But I think that's an example of just, tangentially understanding a new space, bringing in the right people, and building that capacity internally. And we've done that, really across the board here at SomeraRoad.
One of the things that you keep saying is people. And at Dove Hill, my goal for 2024 is to enter a new asset class. And I want to just go even deeper. So taking your expansion into development, clearly you moved first with a person, but bring me back to some of those initial conversations, whether it's development or another asset class, when you're evaluating to go into that, how you think about it and how you then develop a plan and what those kind of early steps are. Does it start with one project? Do you have to kind of own an adjacent site to get comfortable about it? What are some of those early decisions that you're making before you break in?
Yeah. So first off, I would say it starts with a thesis, an idea, a parcel, a development site. It starts with something that we can do. We have the strategy to do. We have the idea to do, but maybe we don't have the skill set and ability to do with our existing team. But an idea, a thesis, something that we think might make sense to effectuate. I think the next step there is then figuring out, what's the human capital that we need to get this done? What does our team need to look like? And whether it was on, there's really been 4 instances of this, at our firm, on the net lease industrial side, on the development side, on the debt side, and on the placemaking, micro neighborhood side, questioning ourselves and saying, how can we become best in class in this space? Who and what do we need to augment our existing team to be as good as it gets in that vertical? And in each of those spaces, over the course of the last few years, we've brought in phenomenal talent to run those initiatives.
When you decided to start SomeraRoad, did it start with a thesis, like an idea? Did it start with a specific project? And then how did you think about building it? Because you came from a place where there was a lot of capital. It was a family office. You came from institutions. They had capital there. But when you go out and start your own company, you have to be very thoughtful with how you're using, whether it's your capital, maybe you had seed investors, I don't know. But how did you figure out where you wanted to go at the earliest stage of when you were starting SomeraRoad?
Yeah, when I started Somera, I had a strategy. I think it was we were still picking up the post GFC pieces. When you think about 2006, 2007, 2008, 10-year fixed rate CMBS loans, those were all hitting the maturity wave around 16, 17, 18. When you hit maturity, obviously, it doesn't necessarily work out that quickly. As we know, with special servicing, it can take a couple of years. So there was a large glut of stuff that was going to be worked out from, say, 16 to 2020. Um, and when I started Somera, I had connectivity into where all of that stuff sat. I had been working in some element of CMBS since the beginning of my career in 2007. Um, and I had traded CMBS bonds on the debt side. I had bought NPLs and REOs out of CMBS trusts. I understood the CCR position, fair market value purchase options, how to work with a special servicer, had deep relationships and IP, if you will, of how that whole world works. Um, so when I started Somera, my strategy was really to dig into that maturity wall and try and find some non-performing loan or REO pieces to acquire out of that legacy CMBS maturity wall. Was fortunate enough early on in starting the business to get control of about $6 billion of legacy CMBS bonds, or control of $6 billion of maturing loans, if you will. And control in CMBS 1.0 meant the ability to hire and fire the special servicer, to get the fair market value purchase option, to get a look on the REO assets as they were being sold out of those trusts. Here we were with a young firm, some phenomenal talent, and we had an opportunity to pick distress out of that wall. Anything in those vintages that defaulted at maturity. From a capital perspective, I had never raised any money before, and it was my first experience needing to raise capital. The first deal was about a $5 million equity check. I put my money where my mouth was. I was a 30-something-year-old young gun, and I started calling on investors, people that had never invested with me before, but people that I had some form of relationship with. And I said, hey, I'm putting $500,000 into this deal myself. Would love to have you invest alongside of me.
Do you remember that first time when you were raising money, or the early days when you were raising money, what something you thought was a truth that actually turned out to be completely untrue?
Really good question. I'd say the one thing that comes to mind is just, I think I had so much to prove, and I might overcomplicating things, and too much information is actually not good. Uh, Investors want, uh, oftentimes they're betting on the jockey, right? Not the horse. They're betting on you. They want a really streamlined, easily digestible summary of the situation, and they want to understand how they're not going to lose money and how they're going to make money. And I think early on we went into such deep evolutions of a pitch deck that were overly complicated, uh, you know, overly verbose, and these really long materials that were probably unnecessary in retrospect. I'll tell you a little bit, more about kind of how I thought about raising capital initially. Um, when we would raise capital for a deal, what I realized early on was there were two things new investors had to get comfortable with. They had to get comfortable with the deal, and they had to get comfortable with me and with the firm and our team. Um, and as we started going into these new markets, one way we fostered relationships with new family offices was bringing in local groups. I realized that we were a brand new firm that had a couple transactions under our belt. Um, but if I had a really good value proposition or a really good business plan or arbitrage on a deal in their backyard, it was hard for them to not get comfortable with the deal. And all I had to do was then do what I said what I was going to do, be an honest and thoughtful and intentional operator, sponsor, manager, and they would get comfortable with us. And we do all those things and take a lot of pride in that. And what we realized from that is, day one, uh, they don't know us, maybe not totally comfortable with us, but they're comfortable with the deal. Day two, and so they do the deal, right? Because they understand the transaction, they take the risk on us. Day two, we bring them from, let's say, Indianapolis family, and now we're doing a deal in Pittsburgh. Now in Pittsburgh, if you've done right by them, they're comfortable with you, and they might not be comfortable with the deal. But now you've kind of 180 that, and you solved another side of the coin. And that was one way we started harvesting these groups and bring a lot of these family offices with us where we went around the country.
Was it intentional to focus on family offices as opposed to big institutional allocators?
Yeah, it's a great question. I think we've seen over the last 10 years a massive disintermediation. From a capital standpoint, we work with all sorts of groups. We've raised about $1 billion of equity to date. A lot of that has come from really large family offices that we have tremendous relationships with. A lot of that has come from institutional partners. So we've worked with about a dozen, blue chip institutional hedge funds or private equity funds. We've worked with insurance companies. Um, we've really gone kind of across the spectrum. Um, I would say family offices are constantly looking for alpha and looking for alternative investments. And I think, as you've seen the amount of wealth created in America at the top within these family office institutions, um, they're often looking for an edge by self-selecting operators rather than going uh, into pooled, non-discretionary real estate funds. Real estate, as I was saying before, it's a tangible asset class. It's an asset class that people understand or think they understand or like to think they understand, and it's a product type that people don't necessarily feel they need a fund for exposure. And if we can connect the right people with the right deals, I think people would rather maintain their discretion and invest directly into transactions. So we fostered a lot of relationships with large family offices and smaller institutions around the country. We have a good understanding of what they're looking for. They're often looking for real estate exposure and looking for it in a non-fund context. That's been a lot of what we've done to date. And if we can match the right transactions with the right acts from specific people, um, it's a win-win for all parties.
I want to talk about raising funds as well, because a couple of my buddies have raised funds and it's hard. And oftentimes it's incredibly expensive. And some of them aren't even breaking even until they're getting maybe over $500 million of equity. How have you experienced the fund side versus going deal by deal? And also then take that a step further and talk to me like how you gain credibility on a deal when maybe the seller or the broker knows that you're going to have to go out and raise capital for this deal. How have you mitigated some of that feedback?
Sure. I mean, so first off, to date, we've done about $3 billion in total transaction volume. We've uh, raised and deployed about $1 billion of equity. Um, Almost all of that, with the exception of our net lease vehicle, which is about $150 million of equity and about, depending on how you cap it, around $800 million of value, has been in a non-fund deal by deal context. Our net lease vehicle, because of the thesis being, uh, uh, the whole is worth more than the sum of the parts as a portfolio, that was done in a single fund. Um, Listen, you mentioned your friends at the $500 million level, as they look to scale and create efficiencies in a fund model. And let's talk about that for a second. I generally view, and there are exceptions to this, but I generally view the world in two ways. There are there's sponsors, operators, executors. There's people that wake up every day and they create value in real estate, and then there's allocators. There's people that create value by building build pools of capital, and allocating those dollars to the first group. Um, I think a lot of people often fall into this trap in the middle, where they raise let's think about real estate funds as and play with that for a second. Let's say you raise a $500 million fund. You got to go deploy $1.5 billion of investable capital. Um, you are doing so in a fee construct that's not all that substantial on a $500 million capital base. I guess when you go back to the operators and the fund managers, you effectively have two groups of people with two very different incentives. The former is promote incentive. They care about creating dollars, driving profits, and having a piece of those profits. And maybe there's some fee streams as well. On the former, you're really just incentivized to scale and to build a fund model. And you never really want to lose capital. It's all about being bigger and bigger. And those two things kind of contradict each other. As you get bigger and you want to put out more dollars, you need more of the former relationship. You need to be more of an allocator. And I think the tweeners there, when you raise a $500 million fund, the fee model off of the asset management fees of a $500 million fund are not all that compelling, especially net of the human capital that you need. So you really are promote focused, but then you're crossed, and it doesn't really make all that much sense at that size. So I think where fund management starts to become really interesting is when you're in that multi-billion-dollar scale. Once you get to that multi-billion-dollar scale, you certainly then need to be using operators to help deploy those amounts of capital. And then when I step back and look at those two options and those two worlds, personally, what gets me excited every day and what I want to be is I want to get out there and be a deal guy. I want to find opportunities to invest capital and create value. I don't necessarily want to just find bigger pools of money to deploy. Does that make sense?
I do want to talk about, I want to go into kind of neighborhoods, because you're in cities like Austin and Nashville that everyone knows, that everyone's talking about, but you're also in other city hubs, but you're less focused on the city and more focused on the neighborhood. So maybe you can kind of talk about what makes a neighborhood, what you're looking for when you're going into a neighborhood, and how you've identified these cities that may have been, or neighborhoods particularly, that may have been less obvious to a lot of other outsiders, whether it's they're based in New York or somewhere else out of that locale.
Yeah, from a neighborhood perspective, I think, in Nashville, we focused a lot on the Gulch and on Wedgewood, Houston. Indianapolis, we focused on the northern side of downtown. In Pittsburgh, we're heavily focused on the south side off of Carson Street at Southside Works. In Kansas City, we're heavily focused on the West Bottoms. In Austin, we're heavily focused on the St. Elmo district on South Congress. I think it largely comes down to building stock. We're really attracted to unique and special, historically significant, architecturally significant buildings, and I think that's like kind of the zeitgeist in America. When you think of neighborhoods around the country that are interesting or compelling in that construct, I think of places like Williamsburg, or like Wynwood, or Deep Ellum, or I was just in the Pearl District in San Antonio. Like these places that have authenticity and history and a story, unique architecture, something that's different and cool and edgy. You think of places like Nulu and Louisville. Like every city's got one of those neighborhoods. We're often drawn to that history and that authenticity. I think we really like leaning into that and building neighborhoods around that.
What are the kind of things that you see to know whether there's going to be enough mass to absorb whatever you're building, whether it's an office or a mixed use play or a hotel or multifamily? Is there something that you walk through and you're like, yeah, this is obvious, or is it more technical based?
We are so micro focused, so case by case focused, right? It's all about supply and demand of that specific product. So like we don't paint a broad brush over any. It comes down to basis too, right? Like there are very few markets that we won't invest in at the right price.
Do you want to talk about offices and why you've kind of set up these local offices? It's almost the Trammell Crow model. And I think of a lot of bigger firms and older firms than yours that have this model, it's so unique that you are a young firm and have prioritized this approach of being local but national at the same time. Why was that important to do that?
So we're based in Nashville and in New York, and we have offices in Austin, Kansas City, Indy, Pittsburgh, and Tampa. Those are all markets that we believe in and have active projects in. Um, I think it's just really important in this business, particularly with large heavy lifts where we're building communities and really leaning into those communities to have a local presence and to have boots on the ground, particularly on heavy development or heavy construction projects. Um, Nashville was a market we came to early, pretty timely with regards to its growth curve. We established a presence here. I'm in Nashville today, and we realized that this was a really compelling place that was growing, and it was a great place to build a HQ2 and a deep bench for our team, not just to work in Nashville, but to work nationally. Our other offices, are all a function of circumstance or, kind of organic in how they happened. In Indy, we have a 500,000 square foot redevelopment of an old car manufacturing facility called the Stutz that we've redeveloped into retail and office, and we're building apartments and more around it. And when you're doing a project of that scale, you really need boots on the ground. You need a team. In Pittsburgh, it's a similar story. We took over Southside Works there and completely reconceptualized and redeveloped the asset, converting the movie theater into the box office, redoing the town square, totally changing the narrative on the retail, redeveloping apartments, building new apartments on the waterfront. So many different projects within one. And when you're doing something, again, that's that comprehensive, you need some boots on the ground. So we hired a local team there. Austin was a function of a market. We wanted to really, dig our heels in and become a more active player in that market. So we started building a nucleus and a team there, and really excited about our first project, our first new project that we closed on there a couple weeks ago. Where else? In Kansas City. Kansas City is a wild project. It's a $350 million plus redevelopment of an entire neighborhood called the West Bottoms. Think of effectively buying all of Williamsburg or Dumbo, like Dave Valentis did, and trying to build all of the components of a live, work, play, stay, multi-dimensional neighborhood. And to do that, you need a team. You need real boots on the ground. So we hired there. But everything is case dependent. It's we don't kind of have a master plan here at Somera. We do what makes sense at any given time. We like to be really thoughtful and be nimble and bring on the right people in the right places as needed.
How has your thinking around placemaking evolved over the past 5 years, particularly in the context of the shift of office?
I think people want these engaging environments with activation and amenities, and they want them to be authentic and thoughtful and well composed. So we spend a ton of time, probably too much time, on placemaking and thinking about all of the pieces at our ground plane to create the most interesting and compelling environment on the ground floor, so that people want to live, work, stay above that. Our thinking has evolved. From a placemaking perspective, a handful of projects come to mind. Southside Works in Pittsburgh, the Paseo in Nashville, the West Bottoms in Kansas City, the Stutz in Indianapolis. And in all of those efforts, we're really trying to create a collaborative, synergistic mix of retailers and public space experiences that kind of are, as we call it, a micro neighborhood, a walkable 5-minute city, if you will, where people can have the vast majority of their needs fulfilled, and can have a really enjoyable experience in an efficient manner, in that little micro community.
How much of the work component comes into the live, work, play nowadays? And what's changed about your approach with how you're thinking about office and how you're utilizing office spaces in your micro neighborhoods?
Yeah, listen, I think work is really important. Or office use is really important to create a high functioning neighborhood. You need the daytime population Monday through Friday, 9 to 5, to help support retailers so they can be healthy. I was just reading this morning about Essex Crossing in New York City, where Verizon had 100,000 square foot lease that they just put out to sublease, and the retail in the market space beneath it has struggled because they don't have you know uh, uh, 500 worker bees that are there Monday through Friday 9 to 5 helping support that. So it is an ecosystem where everything drafts off of each other. The retail attracts the office. The office wants to be there because the retail is there, and the retail survives because the workers are there. And the same thing can be said about the multifamily and the hotel components. Um, I'd say the office is also important from a shared parking construct. We hate to like over park our projects, and one way you can create parking efficiency is with multifamily and office together in the same facility.
How are you changing your thinking about office in this environment though? Like, are you doing less of it? Are the buildings shrinking? Like what's happening?
Office just has to be super special, right? Commoditized, generic, boring office is not going to lease anymore. Being the same as everybody else or creating a value proposition that's based simply around price is just not going to generate any leasing momentum. Um, I think about office as in terms of how big my moat is. My moat being what sets me apart, what makes our product special. How do we have the smallest comp set possible? How can we be the only thing, whether it's locationally, structurally, amenity wise? How can we be the only option? How can we be the most desirable? So, for example, in Indianapolis at the Stutz building, we've done a $75 million comprehensive gut renovation of a historic building to create a really immaculate and special Class A office building. We've created an amenity package from fitness to conference spaces to shared workspaces to tenant lounges to make it, check all of the boxes from an amenity perspective. We've worked thoughtfully from uh, a a parking and signage perspective to check all of those boxes. And then from a retail placemaking perspective, we added all of the components that you could ever want from an office perspective to make it the most desirable. We brought in a bakery and bagel shop. We brought in a coffee shop. We brought in a all day cafe that was largely beloved in the market. We brought in an event space for companies to host large networking events. Brought in a taco shop. We brought in a yoga studio, and really tried to check every single box that you could want upstairs. And lo and behold, we're getting tremendous leasing velocity at the asset, despite downtown Indianapolis struggling. But where else? And we also added a bar, a tap room. So where else in Indy can you have a high quality, great open floor plate, cool creative office, be able to go down to the bakery at Amelia's in the morning and go to barista parlor and grab a coffee, come upstairs, go down for lunch at Julieta's Tacos, come back up and work, find a cool place to work outside in a fun public space, and then go down for beers at the bar at 5 o'clock. It's hard to replicate that, and by creating such a special and unique space, we've been able to separate ourselves from our peers. The same thing can be said about Class A office in New York, right? The best product is leasing extraordinarily well. Commoditized generic product is not seeing any leasing velocity at all. So across our portfolio, we've done everything we can to make our product stand out and be special and unique, to create an environment that's highly desirable, that's activated, that's programmed, that's, from an employer perspective, can help incentivize their employees to come to work. It's a better experience for their employees than being at home. And by doing so, we've created a unique value proposition to those employers, those tenants, and their employees that makes them want to be in our space more than another space.
Hospitality is like the hardest thing, and I love it, and projects love it, and people love going to great hospitality venues, whether it's a hotel, bar, or restaurant. And you've been really thoughtful and actually patient with your projects about kind of layering hospitality in at the right time and not too early. Whereas a lot of people, and I think actually Soho House goes into neighborhoods where they're in some ways the first one there. And you have kind of taken the approach to layer it in after you've already had some momentum, whether that's a hotel or a bar in a mixed use project. What's been your approach with hospitality to date?
Yeah, I mean, on the hotel side, we were just having this debate today with regards to our project in Kansas City in the West Bottoms. I think I tip my hat to Soho House for taking a lot of risk and going into neighborhoods early. For us, when we think of kind of the pieces of the pie, we generally think hotel comes later, and maybe that's just kind of a de-risk perspective. But our hotel pieces in these various micro neighborhood projects is usually added at a later point, or is conceptually added at a later point. With regards to retail and F&B and creating amenities that help drive a neighborhood, in those instances, we work with partners and to have a shared vision for what's going to come. But that's kind of a chicken or an egg. Those things have to come first to give your office tenants or your apartment tenants a sense of neighborhood and experience that they know is going to be there. So we just really creatively structure our transactions to make sure that we can create that place, or as much of that place that we need first, so that the office and multifamily and other components above can be successful. I think one thing that I didn't mention earlier that we spent a lot of time on and are really intentional about is crafting that placemaking in a really authentic manner. Making sure that we have a mix of tenants that are collaborative and synergistic and not competing with one another. We want them to be really successful. And also making sure that we bring things to the market that people want. And that's a combination of really three things. It's locally praised and appreciated tenants that are already in the market and successful, and helping them open a new location or a new concept. And we've worked with a barista parlor from Nashville, really all across the country, helping Andy Muma expand his vision and bring that really phenomenal coffee shop operation into these markets, or with Martha Hoover from Cafe Patachu in Indianapolis, helping her open up a new unit within our Stutz project. The second thing is helping startup entrepreneurs realize their dreams and betting on the right people to help create something de novo. So we worked with Julio Hernandez in Nashville. Julio was a guy I met on Instagram who was selling tacos out of a school bus. And I was like, the tacos were getting a ton of praise and a ton of love. And I called John Reeser, my partner here in Nashville, and I said, we got to talk to this guy. This is awesome. Apparently his tacos are amazing. He's got a ton of momentum behind him and people love him. Let's invest in him. Let's help him build a new thing. And we got to know Julio, and we put a team together, and we said, hey, let's take Maíz de la Vida, which is, again, a taco shop out of a school bus, and let's turn it into something real. And this morning I was over at his space that's opening in a couple months. It's his first brick and mortar Maíz de la Vida, which will be Nashville's best taco operation. So leaning in, number two, to these local folks and helping empower and enable them to effectuate their vision, which creates a lot of value for the neighborhoods that we're trying to craft. And then lastly, which is kind of the one you have to be the most careful about, is bringing in tenants that are new to market from out of market. Particularly being a New Yorker, being a New Yorker, you don't want to just stuff through national tenants that you think are going to be successful in these markets. You don't want to show somebody from, you don't want to force feed somebody from Kansas City some New York operator that you think is as good as it gets. So we've done that selectively and really thoughtfully. Here in Nashville, we brought Two Hands. Two Hands, is a New York, Austin all-day cafe, Australian all-day cafe that serves you, the avocado toasts and the breakfast bowl and the matcha lattes and that need was here. The demand was here. It was undersupplied in Nashville, and they were really welcomed with open arms in this market. But you have to be pretty strategic, kind of bringing something out of town, particularly to a market that has a lot of pride in something local. But whether it's working with existing operators, whether it's helping create de novo operations, or whether it's bringing somebody in from out of town, we kind of aggregate that mix and do it in a really thoughtful manner to create these really authentic experiences that help drive community.
In a local market, how much time do you spend thinking about your competitors and what they're doing?
Probably too much. Yeah, I think there's two schools of thought. There's a lot of folks in this business that put their blinders on and just do their thing. I'm obsessed with information. I'm obsessed with knowing what's going on. Probably to my detriment. It's probably a waste of time. That obsession, I think, runs downhill throughout our company. Knowing how things are capitalized, who bought it, who the lender is, and what the business plan is. I think it's really important to understand the supply side of the business, right? That our competitors are helping create new supply, and we have to understand how we create a value proposition that's separate and distinct from them. And if I don't know the other multifamily buildings being built in Pittsburgh and I'm building one, I don't think I'm doing my job.
It brings back a funny story. I think one of our early interactions together, maybe it was the second time we spoke, you sent me an email, and the email I think was like 3 words, and it had a subject. We had just bought a deal, and the subject was like the name of the deal, and the 3-letter words was, "Who was your lender?" Or "Who did you buy it from?" I forget what it was, but that was it. Just nothing else. 3 words. And then I called you. I'm like, "Hi, hello, how are you?" Have you learned anything from? So, like in Nashville, I guess AJ Capital is kind of playing in some similar markets that you're in, or micro neighborhoods. Whether it's them or someone else, have you learned anything from your competitors or peers that have like kind of shifted the way how you do something?
Oh yeah, I mean, we have tremendous respect for groups like Jamestown or AJ Capital or Turnbridge, who did an amazing job in Music Lane in Austin. We are constantly looking at projects around the country and taking note of what our peers have done successfully and trying to emulate them. And understanding what they do and why, and how or if the economics work is something that's really important to helping us formulate our vision.
Similar to you, this is kind of like a personal question, but I'm guilty of this all the time. I constantly I'll look up people like some of the groups you mentioned. I'm like, who's the CEO of that company? How old is he? What have they done? And I'm like comparing myself and where I am in my career versus others. How do you do that in the context of knowing that real estate is a long-term game and people get places at different times?
Yeah, I mean, first and foremost, like, I don't think of these people as our competitors; they're our peers. There is a lot of real estate to go along. There's a lot of people developing hotels in the same markets that you are, and while you are in some way competitive, you guys are also peers that are that there's enough to go around, right? And there's a lot more opportunity created by working collaboratively than competitively.
It's like your own personal struggle with success and your career goals in the context of everyone else in the business that we're in, and that's of our similar generation.
I just put my head down and I do what I love to do. I'm not. I am constantly looking around at other projects and how people are creating success, and I'm constantly studying and what I think of as smart or intelligent people that are putting on great trades or have really thoughtful strategies. But I'm not necessarily comparing myself to them. I'm just trying to do what I love to do every day, um, and I think success isn't something I like seek. Uh, Wealth isn't something I necessarily seek. I think success and wealth are rewards for doing a good job and creating a lot of value. And I just feel really fortunate that I get to wake up every day with an amazing team, do something I love, hopefully be pretty damn good at it. And if we're good at it, those benefits will come. Um, I look at peers in the business uh, more to learn from than to like compare to.
You send me this book on One Hanover Square. I saw the deck and I'm like, fuck, like I want to have an office in this place. This is like the coolest thing. What is it? And tell me how it's impacting your company and what you're doing with it, because it got me excited. And I just saw a picture.
Yeah, no, that's really kind of you. It's a very special home. We got a call from a friend early in the pandemic saying, "Hey, this club, India House, is has fallen on some tough times and needs to sell their building and needs to do it quickly." Um, and we love to move quickly. And the broker said, "Hey, can you put together a bid to close on this in a week?" And I said, "Absolutely." So we rolled up our sleeves and started sorting through this building. It's this gorgeous, historic, early 1800s, 35,000 square foot townhouse in the middle of the financial district on Hanover Square. It sits adjacent to Stone Street, which was the first paved street in New York City. Tremendous amounts of history there. It sits in front of Hanover Square, which is this really nice park, green space, open air. Financial district is often walls of buildings, and this is this really nice, iconic, big open space. Harry's Steakhouse, which is this also iconic institution in the financial district, sits at our basement level and is just an amazing amenity. And we took this 35,000 square foot building and we completely gut renovated it and turned it into a really special, modern, creative office for small and mid-sized companies. We on the ground floor, we really leaned into a hospitality and amenity oriented model. Built an amazing tenant lounge with a bar, and took a lot of elements we learned from co-working. This is certainly not co-working, but we wanted some of those elements that are fun and nice. So there's beer on tap, there's liquor lockers, there's cold brew on tap, there's a coffee station, and a really nice like kind of hotel lobby on the ground floor, and that's shared and that's everybody's amenity. On the other side of the ground floor, there's a conferencing center. So there's about a half dozen different sized conference rooms and different styles, whether it's couches or tables or conference tables. And I think that just from an efficiency perspective is something that tenants want and need, but don't necessarily need all the time in their space, and makes a lot of sense to share. And then upstairs, we just created really special boutique offices, and we're creating a nice ecosystem there of like-minded companies. But for us, intangibly, it's been a really phenomenal home for our company to help continue to cultivate our culture and our identity as a firm. It's been great. It's been great for company culture. It's been tremendous for hiring, and it's been great for investors and relationship building. But it's just a home that we can be proud of. And I think particularly in New York City, when you're like let's say a 2 to 10,000 square foot tenant, it's hard to have presence and something that feels really special at that size and that scale. Usually, you're a very small component of a very large Class A building, and I think we've been able to kind of turn that on its head and create a really unique and special space for a 25-person team in New York, and have done so for our tenants in the building as well, who can range from say 5 to 50 folks.
So is the concept departing from co-working because the spaces are larger, but it's taking like the best hospitality ideas from co-working, but it's designed for the 2,000 to 8,000 square foot user, something like that?
Yeah, no, I think One Hanover creates a really high quality, amenitized, hospitality oriented building for smaller users and gives them tremendous presence and identity. Whereas they could kind of get lost in the sauce in a larger building that has those amenities. And the buildings that are going to give them that kind of presence are probably going to be of a lower quality.
Is this a brand you want to roll out in some of your other markets?
No, no, definitely.
You're going to keep it.
It's
Just
called
keep it
one.
just for you
It's, a,
guys?
it's One Hanover Square. That's why it's called One Hanover.
It could be a great brand. I'm telling you. It's like I need one down here in Fort Lauderdale. Y- You mentioned company
One thing
culture.
I'll talk about
Go ahead. Go
a
ahead.
little bit is, yeah, no, one thing I'd love to touch on a little bit is just human capital, and I think that's one thing we've taken so much pride on as a company and as a team. Um, we have an amazing group of like-minded, hardworking, passionate folks that love what they do. I always say we live to work. We don't work to live here. Like everybody comes to work and is really excited about what they're working on. Is extraordinarily thoughtful and intentional, and we've just cultivated a tremendous group of people. And I think that's one thing that's really set our team apart.
What have you learned about cultivating that group across multiple different offices? Like, what's been challenging about that, and what's worked and what hasn't?
It really just comes down to bringing on the right people, people that are self motivated and excited to learn, and who naturally rise to the occasion and challenges, and really love working hard, um, and who don't need day to day supervision to execute uh, on their work product. Um, we stay deeply in touch with our team on a constant minute by minute basis. I think COVID helped expose us all to Teams and Zoom and allow us to have really high levels of connectivity, even if we're not in the same place. Um, and we've established kind of you know weekly, monthly, regular rituals that allow our team to stay hyper interconnected.
Can you talk about those some more? What are the rituals that you do?
We have a weekly team meeting every Tuesday morning. Uh, we have asset management touch bases with our team leaders every Monday. Uh, every quarter, we have a quarterly deal review on every single transaction. Twice a year, we have large corporate events where every office gets together. We have two holiday parties, one in Nashville, one in New York.
I like
Having one
it.
tonight in Nashville. Um, but we take a lot of pride in creating a a culture here. We love what we do. We work really hard, but we try and make sure everybody has fun doing it, and is continuing to learn and challenge themselves and grow as individuals. One thing that we focus on when we hire here is really untapped potential. So uh, we like bringing on talented folks that uh, are capable of more, um, and unclipping their wings and letting them go. And we've experienced that across the ranks here at Somera, taking younger talent that might be in a box or siloed or uh, uh, suppressed by a senior manager, and saying, you know what, here's a great opportunity, run with it, see what you're capable of, and trial by fire, right? I think the first couple months at SomeraRoad can be pretty challenging for folks, hitting the ground running, and um, really just being unleashed. But I think for people that are self motivated, it's a phenomenal place to work, and learn. I can't tell you how often I hear from a new junior hire that they've learned more in 3 months at SomeraRoad than they did in the first 3 years of their career. And I love hearing that, and take a lot of pride in providing that environment for people to grow as professionals.
Do you convey that as part of your recruiting process? Because I'm sure you're competing against people with, much bigger balance sheets, maybe a bigger name. Is that a really integral part to how you hire?
Yeah, I think it's uh, providing people an opportunity to have significantly more responsibility than they would in like a hyper institutional model. Um, Having a lot more autonomy, um, I think, is something that's really attractive to a lot of folks today, and that's something we definitely explain to folks when they come on. But we certainly make them aware that it's not easy. There's no hiding. This is a very transparent and flat organization. Uh, Everybody is fulfilling an essential role, and everybody is adding tremendous value to the team. There's nobody over there in the corner that's surfing the web every day.
With all these projects, I mean, this may seem like a dumb question, but how do you figure out if something's going wrong? Like, how do you know? Maybe it's a dumb question, but you're talking to people all the time. And I'm curious, like, you're in all these different markets. I want to know how you keep the pulse on whether your goals are being met and returns are where you want them to be or milestones are being achieved.
Yeah, I mean, we have. I certainly can't be in all of these markets at the same time. We have 100+ investments in 70 some odd markets around the country. We're actively focused in about a dozen markets. We have tremendous senior leadership here, while being a flat organization, we do have a lot of kind of vertical responsibility. So I have phenomenal partners and phenomenal senior leaders that are constantly overviewing business plan execution, making sure our performers are working, and assuring that those checks and balances are there. Let's talk about the industrial net lease space.
It was pretty hot. I mean, how do you feel about it? Unpack it. Talk to me about it.
No, I absolutely love our industrial net lease business. That's run by my partner Brian Mansouri. You know, I think for a variety of reasons, industrial real estate is as safe and secure of an income stream as it gets in our space today. Um, you know, it's a really nice complement to what we do as a business, whether it's on the value add or the development side. I think of our net lease business as kind of our yield focused strategy. And what we've been able to do is effectuate and assemble a phenomenal portfolio of uh, strong credit industrial tenants that have a long WALT and are embedded in their respective facilities, and created a great income stream around them.
Where's your company Christmas party night? Let's start there because Nashville is probably the most fun city there is. Are you going to like a rodeo or?
No, we actually brought Blind Barber. That's a tenant I failed to mention. I don't know if you know Blind Barber.
I've heard of them.
They're
Yeah.
in Philly. They're in New York, LA, across the country. They were in Miami at one point. I think one of their partners is Bryce Harper, the baseball player. Really cool tenant. It's a speakeasy in the front and a barbershop in the front and a speakeasy in the back, and you go through the barbershop to get to the bar. Barbershop by day, speakeasy or cocktail bar by night. We brought them to Nashville. 2-year journey with their team, finding them the right space and bringing them into our project. And to go full circle, our holiday party will be there at our project with our tenant tonight. I'm excited to support them.
Where do you get inspiration from for these like placemaking projects? Is it from your travels? Is it from eating?
Travel, day-to-day life. I love exploring various cities and learning kind of what's cool and what's happening, whether it's restaurants or retailers. And I love kind of following those trends and experiencing those things in the real world. And I think I probably drive a lot of my team crazy with how much I email them on a Saturday or a Sunday when I'm out with my family and I see something, I experience something. I'm like, this is a really good idea, or this is the kind of tenant that we should bring to this project. Let's go back to the industrial net lease business. So our competitive advantage in that space, I think, is one, we have a deep credit background, and we have a deep debt capital markets background. So Amit Patel oversees our debt capital markets and our CMBS trading operation. Brian Mansouri oversees our industrial net lease business as a whole. But what the net lease business allows us to marry is our ability to underwrite credit, our ability to strategically capitalize projects from a debt and equity perspective, our ability to understand real estate across the country from a geographic perspective, and really marry all of that together to create a stable income stream and a yield-focused platform.
For that business, are there certain like market characteristics that are more interesting to you than others, or are you more so focused on the yield and you'll go to whatever market presents that yield?
I'd say it's a combination of components. We're largely just looking for sticky tenancy, credit-worthy tenants that are embedded, that aren't going anywhere. We're looking to own those assets below replacement costs. We're looking for leases that are below market leases. We're looking for tenants that have invested a lot in their space, that have a workforce that is captive in that space. And Yeah, I mean, we're really just assessing the credit worthiness of the underlying company, and how embedded that tenant is in the building.
What does the next 5 years at Somera look like, and what are your goals?
I think our goal as a firm is to continue executing on the projects that we have and to find new and creative ways to create value in commercial real estate, and to continue growing and challenging ourselves. We have learned so much since inception. We've grown with such tremendous people, and I want to keep doing that. And you know, I want to continue to learn, continue to grow, continue to do it with people I like working with every day, and I want to have fun doing it. And I think myself and our team are fortunate enough to do that right now. And Yeah, constantly challenging ourselves to learn about new verticals and learn new spaces, and never get bored.
What about this? Tell me about your best deal that you've done, and you can define that however you like it.
So the best deal we've ever done, I would say, or a deal that I love, is a deal we did in Rockford, Illinois, called Love's Park. I think it was called Schneider Electric at one point. It was a distressed CMBS deal. I think like a 20 some odd $1 million loan that had gone REO. Um, a rather hideous 550,000 square foot industrial facility with some office in the middle of nowhere. Um, it was REO. It was going to auction, and my team didn't want to touch it. But I saw something in there that I really liked, and it's like 135,000 square foot lease to General Electric Aviation, GE Aviation, and we actually knew GE Aviation because we had done a deal with them in Jacksonville, Florida, and so we had a relationship with the tenant. And I called up one of the real estate managers there, who I worked with, and I very quickly got an understanding that they needed this space, and the space was mission critical to their business. They make a helicopter component out of that facility. So knowing that and understanding the company and understanding its mission criticality to their business and understanding the amount of investment that we had in there, I felt really comfortable that they were pretty sticky. Anyways, we bought this 550,000 square foot facility in the middle of nowhere that was, I want to say, about 40% or less occupied, for $6 a foot, for about $3 and change million. And it was a very complicated, dated asset that had a bunch of pieces kind of bolted onto it. But we acquired it for $3 and change million. We subsequently got a 15-year extension done with General Electric on an expansion to about 200,000 square feet. And then working with our team here, we were able to lease it to about 85% occupancy and grow NOI to about $1.5 million. And just a phenomenal trade, cash out refinancing, and an asset that I think we'll own for a very long time to come. But what I love about that is, like, you can create value anywhere. It just comes down to basis and value proposition. Whether you are able to drive leasing velocity and sell a product, as in space, to a tenant, at the right price. So we just take a lot of pride in basis, making sure we own our assets at a value where we can create a value proposition to a tenant that's attractive. And it turns out in Rockford, Illinois, if you own your asset at the right price, there's certainly demand for industrial, as we saw there.
I asked all the guests on the podcast the same closing question. I'm excited to hear your answer. What is your favorite hotel?
I have three favorites. Can I give you that?
Give me all three.
I travel every week. I'm going to stay domestic, and I love experiencing new hotels. One thing I push throughout the company is we never stay in the same hotel twice when we're in a market. I think it's a really important way to learn a new market, not getting in a repetition. Always trying to experience as many neighborhoods as possible, and as many places as possible. Three favorite hotels right now that come to mind. First off, in my hometown in New York, I absolutely love the Pendry Manhattan West. I think it's a tremendous asset, and I think Michael and Alan Firstman and the Montage team did an amazing job there. They worked with the Stillman's Quality restaurant group and did an amazing job with Zuzu's. And from an interior design perspective, I just think it really hit the mark. And believe it or not, it's the number one rated asset on hotel on TripAdvisor in all of New York City. So love that hotel and love the experiences I've had there. Second, I contradict my rule with regards to Kansas City. Now, I have been there 75 some odd times, so I've stayed in every single hotel in the market. But the one I always go back to is the Crossroads Hotel, which is owned by our friends at the Imperium Group out of Chicago. They've done just an amazing job of creating kind of the heart and soul of the Crossroads district and a really exciting lobby vibe that's kind of like a hearth in the middle of that neighborhood. And then lastly, I really enjoy the Proper in Austin. I think that's a phenomenal asset that really hits the mark and was the perfect hotel in the perfect location at the right time for that city. And is a really enjoyable place to stay.
What's amazing about that hotel is the food and beverage volume that they do. It's phenomenal.
Yeah, Liz Lampert and Larry McGuire partnered to execute the F&B strategy there. I talked to and know those two pretty well. They've done an amazing job there, and I have a lot of respect for what they've been able to build throughout their careers. And I think the partnership there was really well put together, and was a great team that executed phenomenally well together.
The other thing that's interesting about that hotel is they gave it a soul and a sense of place, and they did it in a new building without it feeling like a new building on the inside, which is very hard to do.
Absolutely.
Thanks for coming on the podcast.
Of course, man. Happy to.
Hey, everyone. It's Jake here. Thanks again for joining me on this conversation. Be sure to subscribe on Apple Podcasts, Spotify, or YouTube. Lastly, don't forget to follow me on Twitter at @JWurzak. I'll see you in the next episode.
Jake Wurzak is the founder and CEO of Dove Hill Capital Management. All opinions expressed by Jake and his guests are solely their own and do not reflect the opinions of Dove Hill Capital Management. This podcast is for informational purposes only and does not reflect or represent real estate, financial, or investment advice.